So as we saw when we came to business income, it's a big deal to separate income from capital. And so one place that gets us into trouble is this idea of capital assets, because capital assets are capital, but they contribute to the income generation each year. And so the Income Tax Act has to deal with them in some way that involves both income and capital. So Chapter 5 basically lays this out, and in this video what I'm going to do is focus really on the basics, because there's a lot of nitpicky stuff that goes on around the calculation of capital cost allowance, but we want to get the foundation laid solidly before we deal with those nitpicky little things. So let's just talk about the basics and see if we can get an understanding of the system. It's not entirely different in principle from financial accounting, so you can definitely rely on your understanding of how depreciation works in financial accounting, but we want to note the differences. So the Income Tax Act, according to the Income Tax Act, every asset in the world, or that a company ever owns, can be put into one of three buckets. It's either non-depreciable, depreciable, or something called eligible. So what's non-depreciable? I think most people would give the example of land or investments. Okay, so like shares or debt, things like that. And these things have what we would call, they live forever. So let's just say they're not used up. Time does not affect them. Then we have things that are depreciable, and so we'll use buildings, machines, the usual suspects of what companies need. And these things have limited lives, right? Time and use. So time and use kill them, right? Basically, right? They wear them down and they need to be replaced. And then the last one is eligible capital property, which is, in financial accounting we kind of think about them as depreciable and non-depreciable. And then we have these ones that tax needs to deal with a little bit separately, which are, for the most part, intangibles. So we can think of things like patents and goodwill. And so they're kind of a halfway between the other two buckets in that they, time doesn't hurt them, but they usually have lives. So they're not used up necessarily by time, but they do usually have lives. Okay, so that's essentially the landscape that we have here. And so for tax purposes, what we need to understand here is that if you have something that will never die, there's no amortization, no deduction through amortization. So we're not going to take a little piece of this to the income statement each year. We are going to just have it hit the income statement in the year that it's disposed, almost always, or as a capital gain. Okay, here we're going to take this thing called CCA. So each year I'm going to put annually, we will take a little piece of this depreciable asset to the income statement for tax purposes, similar to what we do for financial accounting. And then the last one is just it's very similar in concept for these ones, but it's just done differently. And again, it's done annually, but under a different system. Okay, so what we want to focus on is the one that is the most common and causes the most trouble, which is this one. So depreciable property is the stuff that's going to the income statement each year and being used up through time and use. Okay, so what this introduces, so now we're in this world and we've got assets, all of which are depreciable. And what these do is these feed down into another whole series of buckets. So I'm not going to draw all the buckets because there's a whole lot of them. But the buckets are called classes. So we have class 1, class 8, class 10, etc. Okay, so any number we go. So just note there's a lot more of these things. It's a whole range of these buckets. And all of these depreciable assets have to fit into one of these buckets. So if it's depreciable, now you have to figure out which class does it go into. Okay, so we picture. I won't burden you with my artwork too much, but here we have a car. So here's our car. Okay, pitiful car. Sorry. And here it goes whoop, into the bucket. Okay, so it belongs in the class 10 bucket. Okay, so let's zoom in on that bucket. So we're going to use the class 10 as our example. And the way that we calculate CCA is basically at the bucket level. So we all, in the examples that we've seen so far, we've sort of been handed these CCA numbers and been handed this overall depreciation for the company as a whole. Well, in real life, the CCA is calculated at the bucket level, but each asset does maintain its own, keep track of itself, or we keep track of each asset. So let's zoom in on this just a little bit. And so and I view this in 3 steps. So you can look at the textbook, and it does it a lot more sort of technically and mathematically, formulaically. But this is how I think it might be useful for you to picture it. Okay, so if we have our class 10 bucket here, we start the year with, and we'll draw it as water, even though, well, actually, let's not draw it as water. Let's draw it as cars and computers, because that's what class 10 is. So we have a bunch of cars in here. Okay, I won't draw too many. So we have a bunch of cars, and then we have a bunch of computers. So those squares, those are computers. And so black means old, means it existed at the beginning of the year. Okay, so that's our starting point. And so each of these things has what is associated with it, a UCC amount. So the UCC, the undepreciated capital cost, is the amount that has not yet gone to the income statement. So cost, let me be clear, cost not yet deducted, or if you wanted to say waiting to be deducted. Okay, then step 2 comes along, and we'll use green for new. So step 2 is we buy some new things in the year. So we buy a couple new cars. So there's a car that we buy. There's another car that we buy. And I'm going to, for now, I'm going to ignore the half-year rule. So just make a note. If you've done the reading, you know about this thing called the half-year rule. We'll ignore it until the end because it's just a complicating factor. We don't need it for the fundamentals here. So we buy some things. Those come in. Let's buy some new computers too. So we buy a couple of new computers. And each of those computers brings with it new UCC, new cost that needs to be deducted at some point. Okay, so we're going to add that UCC. And so now we've got this sort of this new UCC balance here that we can use to deduct. But we're not quite done because there's a third piece that comes along and says, okay, so step 3 is this car. So this particular car died and got either was sold or just fell apart. And this computer stopped working and we threw it out. Okay, so some things left and some things came in. The things that left took some UCC with them. Okay, so they had some undepreciated costs that could have gone to the income statement had they stayed around, but they took it with them. And so now we're left with this final, as we can talk about for the year, we will have this amount that is kind of the net UCC. After we've added and we subtracted, we've got this net UCC that we can then apply our CCA rate to. Okay, which in the case of a class 10, which is computers and cars, it's 30%. Okay, so we apply our CCA rate of 30%. So now I kind of need to redraw the bucket. Okay, so I'll redraw the bucket really quickly and say, okay, where are we at now? Because we've got all of these. So that car's gone. Let me just scroll this down just a little bit. So that car's gone, but now but that computer's there. This car is here. this computer is here, this computer's here, this computer's here. And now we can draw these as old because now they're just part of the family. So we've got all these, sorry, that it looks like a clover, not a car, but I think hopefully the point is made. Now we have this, but we have calculated this CCA. So we took this and we got CCA. And what that means is that each of these guys has had some CCA taken out. And so the bucket, the overall UCC in the bucket has gone down. Okay, so they're all still there, but CCA reduces the overall UCC. So we've got this idea of the UCC, this net UCC here, we need to take out this year's CCA to arrive at what? The UCC that will become for next year's number 1. Okay, so by which I mean, can I get there? This way back here. Okay, so it's the circle of life, and we would just start all over again. Okay, so hopefully, if you can go back over the video, I guess, and see the process again, it's not as complicated as it seems, but you need to understand how these things happen and what number the rate actually gets applied to, or else you can get quite confused. Okay, so we need to have the right number there before we apply the rate. Then we take out the CCA to get at the point where we have this UCC, which is the number that we're trying to get to take to next year. Okay, so and the half-year rule complicates that a bit, as you'll see in the textbook, but I'll talk about the half-year rule right at the end. Okay, next point is we have this problem that's created by the fact that these things are both capital and income, right? So we know that for a capital asset, so if when we sell capital assets, we know what will result, right? It'll be proceeds minus cost equals gain, and we know for tax purposes that that's if it's a gain. Let's assume that you sell it for more than you bought it for. We know that, right? But we also know that on the income side, we're taking this CCA to the income statement each year. So it's reducing income each year, right? So CCA to, let's just put it this way, CCA reduces income each year. And what is CCA? CCA is just a little piece of cost, right? So we think, okay, wait a minute. So this cost is exactly the same cost. And so it's going to both reduce a gain and it's reducing income as we go. That doesn't seem quite right. And that's the problem. Okay, so that does create a problem. So let's picture, so what we know has, let's picture a car. Okay, I apologize, I'm going to draw one more car. So here's our car. Okay, souped up thing that looks like a hot dog. So there's our car, and what we know is that it's bought for, so let's say they buy it for $40,000. Okay, and then 3 years later, let's say 4 years later, sell for, what should we get them to get? So how about $25,000? So they get $25,000 for it. Okay, so that's a fact. What is this difference? Whoops, sorry. This is $15,000. And what do we know about this $15,000? Well, what we know about this $15,000 is that this must be equal to the total reduction of income while they had the car. Okay, so because what they have incurred, and as far as the income tax act is concerned, what they've incurred is $15,000. So that should be the total amount once we've summed up everything. So it should have reduced total income over all the years that they had it. So over these 4 years, $15,000 should have been deducted in total. Okay, but we know the problem here, though, is that we know CCA is taken each year. So let's just assume that total so I'll make an assumption, or I'll introduce a fact here. Total CCA was let's just put it at $19,000. Okay, I have no idea what it would actually be, but let's just say it was $19,000. So what that means is they have deducted $4,000 more than than they should. Okay? And so what this $4,000 is something that needs to be brought back into income. Needs to be income. Why? Because the total deductions have been 19. They should be 15. So there's the difference, $4,000. Okay, so that's what we have to do. We have to bring that back into income. And so what this is called recapture. We need to recapture it into income. Okay? Now what if it went the other way? What if so this is scenario 1. What about in scenario 2 the total had gone the other way? So the total CCA that they've taken so far was, I don't know, let's make it easy, $9,000. Okay, so what if they'd only taken CCA of $9,000? Well, we know that they should have taken, so let's just use this again here. So the total deduction is 9, should be 15. So in this case the difference is 6, but in the other direction. Okay, so we note here that the direction is the wrong way. And so where should this 6, what should happen to this 6? Well, this should be deducted. Right? So that the total deduction, we've got 9, we should have 15. We need the total amount to be increased by 6. And what this is called a terminal loss. Now, the tricky thing is that recapture is done when an asset is sold and its individual reconciliation doesn't line up and you get more for it. A terminal loss is only taken in most classes only when the class is empty, or maybe a better way to say it, when the asset that you are disposing of is the last asset in the class. So our bucket is empty. Okay? So these are important concepts, because what these do, the terminal loss and recapture do, is basically true us up. So CCA is being taken on an annual basis, but at the end of the day, in the final analysis, we need to have the right amount in aggregate having been deducted. And so recapture and terminal loss make that happen. Okay, so let me just finish up here with the half-year rule. And the half-year rule is well named, because all it says is in the year of, so the year that's being referred to here is the year in which you purchase or sell the asset or dispose of the asset. In that year, you only include half of the UCC that you otherwise would when you build up your UCC pool. Now we normally think about it as using half the rate. So we normally think of 1/2 times the rate. So we've seen questions actually that involved cars, and we said the rate is a half of 30, so 15. And it's normally fine to think about that, but really the mechanics of it are that you're actually doing half of the UCC. And the reason that matters is you'll see that when you build up what the UCC balance is for each year in the textbook, you have to take the half pieces out, do your CCA calculation, and then bring them back in. And that's why it's important to think about it as being half of the UCC rather than taking half of the rate. But the principle is exactly the same. And why is it there? It's just there so that on average, if you buy an asset at the beginning of the year, the end of the year, you're not gaining advantage. Now, we could prorate by day, but we don't. Okay, so it's just a half-year rule that's just a blanket thing to say, don't bother trying to get big expenses this year by buying all your assets in December. We're going to limit that at least a little bit by cutting it in half.